New topic. History of investing. What is it? Why is it important? It's important because there is a tremendous amount of data. I'm going to get comfortable here because this is an intense conversation here. The history of investing is crucial information because most people tend to think of their investing portfolio as just some kind of pie chart. They fail to grasp. Just the other day, an advisor was saying, well, how do I communicate with an investor all the richness and robustness of what actually goes into a portfolio and the true value of how their portfolio is created? And to a large extent, that speaks to the actual history of how portfolios are built and how they're put together. So our history timeline, even though theoretically we could take this all the way back to the dawn of mankind, we're taking right here back to 1776, and we're taking it to Adam Smith and the Wealth of Nations. And the basic idea was this, that free markets work, that through supply and demand, informational systems are created that convey both consumers and suppliers, people that are producing the products and services, and that through free trade, you maximize the wealth to the individual and you maximize the wealth to the society. This was a very countercultural idea because in the day when this was written, you would still have the monarchies, what was left of the monarchies falling apart. And in the past, it was one centralized monarchy, one centralized controlled system that was supposedly determining what things were worth and who owned property. So this was a very revolutionary idea in 1776. In 1792, the New York Stock Exchange is founded. Very powerful thing that started actually as a result of people speculating, buying and selling shares of stocks of companies that were basically taking goods across the ocean, and they would basically bet from a mercantile standpoint which ships would make it and which weren't. And you would actually, in the bars where they were serving liquor, you would actually buy your lottery tickets and buy your shares in the ownership of these vessels that were coming over. And that was the very basis, basically almost not an accident. No one really had this vision of 200 years, 300 years of what it would actually look like to create massive capital for society. It was basically an evolutionary event spurred by initial gambling. 1847, you can notice here this huge time lapse here, almost 80 years between when Adam Smith talked about the Wealth of Nations to Karl Marx, which we just talked about, Communist Manifesto. And in this he said, no, free supply and demand will not work. What you need is you need centralized planning, you need centralized committees, the power of setting prices, the power of distributions of goods and services, even the power of where you work, how you eat, where you sleep. Every aspect of your life should be controlled by a centralized government, therefore confiscating the property from capitalists and taking away any free rights that the workers had. So Karl Marx said this in 1847. These are two ideas that are mutually exclusive. You can't believe on one hand that free markets work and believe in centralized planning committees. They're completely out of sync with each other. And there you can see the two philosophers, Adam Smith in the 1700s and then Karl Marx here in the 1818. So what are the implications of the global political worldview of this? Well, Adam Smith in 1776, basic foundation that markets work, laid the groundwork for capitalism, the idea that personal property rights, to own buildings, to own your own tools, to own your own trade, to own factories, manufacturing, is the basic foundation of capitalism. Price determined by supply and demand without any government intervention. The focus then should be on individual rights, individual liberties. These were the founding principles that our founding fathers in America knew and understood very, very well. The consumer in this process determines the ultimate value. Look at our economy today. Who determines if Bill Gates is rich? Is it some federal government? Well, depends what industry you're talking about. But in a free market society, it's the consumer that has all the power. You might not like it if you have to pay $2,000 for a laptop computer, but you are free to choose. Therefore, the consumer has the ultimate power of who gains wealth. And they vote for who gains wealth by buying products or services. The goal then, based on Adam Smith, is individual freedom and liberty. And individual accountability for results in life. And when you have freedom and liberty, some people are going to be extremely successful, some people aren't going to be successful, and then you're going to have the vast majority in the middle. But as a whole, capitalism believes in the idea that a rising tide rises all ships. And here's what they said. So results: increased personal freedom and rights, individual maximization, and social wealth. Karl Marx said, nope, his primary work, Manifesto, markets fail. We want socialism and communism. As a matter of fact, socialism wasn't even enough for him. He spends a lot of time in the Communist Manifestos talking about socialism doesn't go nearly far enough. And then he talks about that the state should fix the prices and the state should own all capital and means of production. Focus on the state rights, not individual rights. Individual rights do not matter in a communist society. State sets the value. So the state then determines who creates the wealth. The state determines by big man theory, who's ever at the top of the pyramid, who gets wealth. So to gain wealth in a socialist or communist society, you don't please the consumers, you have to please the big man at the top of the pyramid. The goal, the theoretical goal, is equality of outcome. But within Marx's own twisted view of things, he forgets to account for the fact that politicians are just as greedy and guilty as so-called capitalists. But here, unfortunately, at the state, with the military behind them, then you have the power of the military to then crush citizens and confiscate their rights. Results: increased control by state, decreased individual rights and freedoms, increased police state, and eventual fascism or dictatorship, always at the end of the communist rainbow. Why does this have to do with investing? Because you have two different worldviews of investing. Free markets work to set prices of stocks and securities at the best possible level based on the invisible hand, versus the centralized committee that mutual fund institutions would have you believe can identify mispricings in advance. Benjamin Graham comes along in 1934 and writes a book about stock picking and says that stock picking, you can actually try to find underpriced securities based on information that no one else has, and that based on this information, he called it fundamental analysis, you can add rates of returns to the portfolio. There's Benjamin Graham, Stock Picker's Bible. Studying market fundamentals can add additional rates of returns. What is the implication based on these very two different ways of looking at the world for how you would invest? If you believe in the philosophies of Adam Smith, you have to believe that markets work, that supply and demand is the best determinants. You would also believe that new information or new news, as it was incorporated into the pricing system, would move prices randomly and unpredictably throughout time. An early proponent of this from an investment standpoint is Paul Samuelson. The strategies that you would employ based on this is you would own asset categories versus individual stocks. You would diversify using Harry Markowitz and modern portfolio theory, and then you would rebalance periodically based on swings in your market portfolio. Karl Marx, based on markets fail, you would want a guru who would theoretically be able to guess and use some kind of centralized planning committee at the mutual fund or institutional level to outguess the market and add value to the investor. They would believe that prices move predictably, that somehow they have an idea of what real prices should be. And one of the early proponents is Benjamin Graham. If you believed in this strategy, you would pursue stock picking, market timing, and track record investing. It's interesting to understand that Benjamin Graham later on his deathbed recants and says that he is now, or was before his death, on the side of the efficient market theorist, and that he no longer believed, as he did in his youth, that stock picking was actually a viable method of adding rates of returns to your portfolio. In 1952, Harry Markowitz comes along at the University of Chicago, writes a paper about taking standard statistics and taking dissimilar price movements and actually building a portfolio that has higher expected returns based on the mix of assets given any level of volatility. And he developed something called the efficient frontier. And the efficient frontiers basically said this, that you could build these mixes of assets and you can measure their volatility, and the goal of the investor was to become a means variance investor, meaning to get the highest expected return for any mix of assets with the lowest amount of volatility. And those two determinants should be the overall driver if an investor is educated of how to build a portfolio. As a matter of fact, we spend a great deal of time helping investors understand means variance investing, because this is the true groundwork research that was done for modern portfolio theory. And there's Harry Markowitz. His paper was first published in the Portfolio Selection, published in the Journal of Finance, Lower Correlations, and he then goes on to win the actual Nobel Prize in 1990. 1960, Most people would not have this in their timeline, but I think it's an extremely important piece of any timeline. Edward Lorenz came up with an idea called chaos theory. One of the questions that I've asked myself many times over the years is, why does the market, number one, create returns or premiums, and number two, why is it so unpredictable? Well, the reason that it works this way is explained by chaos theory. What chaos theory says is that there are self-regulating systems that have somewhat over long periods of time predictable outcomes, but are perfectly random. A great example of that is the weather. The average temperature in Cincinnati is 55 degrees rather, but what the weather's going to be 3 weeks from now is absolutely unpredictable. It could be a sunny day and 80 degrees, or it could be 35 degrees. Especially in Cincinnati weather. So what he says is that a chaotic system has massive swings based on undeterminable factors. Most investors and economists, a lot of times when I'm on the news debating people, want to treat the economy as if it was a deterministic system. Meaning if you know X and Y, you can have a simple little formula and that's going to give you Z. In reality, a chaotic system is one in where the formulas often change. So based on additional input, the formulas themselves change over time. In addition, in a chaotic system, small incremental unpredictable outcomes or initial determinants make massive outcomes. This was something called the butterfly effect. And Lorenzo said, imagine in your mind a butterfly flapping its wings in China could create a hurricane in Texas. And so what he said is that these small, unmeasurable initial states end up magnifying into these massive unpredictable events. And I think definitely over the last year and a half here, you've definitely seen some of the butterfly effect taking place, both on the downside and then subsequently here on the upside here recently. There's Edward Lorenz, studied at MIT, studied the weather patterns. Another thing that I really kind of think about when I think about Edward Lorenz and these different people is that it's amazing how many different disciplines that you have to be able to put together to truly understand investing. It's not just economics. It's the combination of human behavior, philosophy, investment strategy, finance, theory, even weather and chaotic systems. So to really be a great investor and understand all this and put it all together is an extremely rigorous process. 1964, William Sharpe comes along, talks about beta or Sharpe measurement. What Bill Sharpe says, okay, what we can do is we can take any stock or a portfolio, we can measure its volatility, and then we can measure the per unit risk that it takes. And so we can actually show how efficient a portfolio is at developing rates of returns. And then we can measure per unit of risk how efficient that portfolio is at developing return. There's William Sharpe right there. Paul Samuelson, 1965. Even though people knew or suspected during this period of time previously that markets move randomly, Samuelson comes along and says in 1965, price movements through time are perfectly random and unpredictable. There is no rhyme or reason to how they move. And the reason, he said, is because of news. If you look at news, the root word is new. Stocks and equities will move, and even interest rates and bonds will move based on new information that is unpredictable. Because news is always new and unpredictable, the prices will also move randomly throughout time. And there's Paul Samuelson there talking about the random and unpredictability of markets. Jensen came along and Beckenkamp, and they looked at 1945 to 1964, and they said, what would happen if investors owned all the stocks? Instead of stock picking, which had been the wisdom of the day, what would happen if you just owned a broad market index? For example, owning all the S&P 500, or even owning every single stock in the market. And once they were able to create these indexes, what they found is that managers consistently failed to a very high degree to underperform market benchmarks. Because of that, the idea comes along that, well, maybe, just maybe, people should buy the index, eliminate stock picking altogether. And there's some debate in the 1970s who exactly came up with the first index. Was it Rex Sinquefield or John McCohen, first index fund? But the first S&P 500 was created at this time period and funded by large Fortune 500 pension plans. 1973, Burton Malkiel comes along. He was the first person to popularize. He didn't really do any of this initial research. What he did was he went back and looked at all the academic research and actually put it into a format where investors could actually understand it. And he wrote the seminal work, A Random Walk Down Wall Street. Prices are random, markets are efficient, and this is exactly indicative, going back all the way to the 1700s, of what Adam Smith said. And it was a vindication in reality of the very theories that Smith came up with so many years ago. 1977, Ipsen and Sinkfeld formed their database. Stocks, bonds, bills, and inflation becomes required study material for CFAs. There's Sinkfeld going back all the way to 1926, looking at different asset categories. And then in 1981, Ralph Bond steps in and identifies a premium. The original work with stocks, bonds, and bills of inflation identified a premium for owning stocks of around 6% per year over T-bills. And when Ralph Benz comes in, he says, not only is there a premium for owning stocks over fixed, there's also a premium for owning, owning large over fixed. There's also a premium if I'm willing to own microcap. And that premium historically, going back to 1926, is in the ballpark of 2 to 3% per year. This, incidentally, is also the time that DFA opens their first DFA fund for microcaps to capture that for institutional clients. And there's Rolf there. Fromm and French come along here in the 80s, and they identify yet a third premium they call the value premium. And by looking at the different determinants of rates of returns, they see that the stock premium is important, the microcap premium is important, and the book-to-market value premium was essential to capturing additional rates of returns. And what they did is they just took the book value of companies, they ranked them from divided by the market price, they ranked them from highest to lowest, they took the top 1/3 of the market, then they broke it into size based on small and large companies, and they showed that there's an additional 3 to 4% premium for investors who are willing to allocate into that portion of their markets. 1988, F.A. Hayek wins the Nobel Prize for research he did initially in the 1929s. He wrote The Fatal Conceit and The Road to Serfdom. He wins the Nobel Prize in 1988, a further vindication of the idea of Adam Smith that these large processing systems, that the market is the most amazing information processing system on the planet, that it takes the hopes and fears, information, statistics, data, and plans of over 6 billion people on the planet. As a matter of fact, I gave Kenny an assignment the other day. I'm going to put you on the spot here, Kenny.
Nice.
Okay? I asked him, if you were going to try to play God and actually try to accurately predict the market, how many neurons in individuals, people, because the behavior of the market prices are made up of individuals' behavior. But not just the behavior of the people that are buying and selling the stock that day. It's made up of the behavior of the consumers. It's based on the behavior of politicians. Unfortunately, it's based on the behavior of theorists. It's based on everybody's actions. People that are retiring, whether they want their capital, where they need their capital. Everybody's plans, hopes, and fears on the planet factor into this information processing system known as the stock market. So what I want to know is, number one, how many individual nerve connections in the human mind? Do you remember that one?
10 billion.
So there are 10 billion nerve connections. So if you wanted to just predict my behavior, Mark Mattson's behavior, and any of you guys that have kids out there, you know this to be true. If you want to predict the behavior of one of your kids, you got to line up 10 billion neurons in their brain, connections, and be able to predict what happens. Now, Kenny, how many 10 billion times the number of people on the planet? The number of people on the planet is?
There's 6.83 billion.
6.83 billion, coming right in on 7. Okay, if I multiply the number of neurons times the number of people, what do I end up with?
I believe it was 6.83 times 10 to the 23rd.
Okay, I'm going to say that again. 6.83 times 10 to the 23rd decibel. That's a big, Kenny, that is a big number.
It is, yes.
Okay. So think about this. The actual stock market, when you see a stock trade at $49, $49.50, what that says is that is all those neurons firing, the supply and demand, the information being processed instantaneously of all of that going on. I mean, the modern day stock market is an absolute miracle of human development. It is something that no one individual could have ever imagined or created. It is the greatest information processing system on the planet. It is also, similarly, the greatest wealth creation tool known on the planet. It has created more wealth and more opportunity for more people all over the globe. And it is in direct conflict with the idea of communism and centralized government control. The two ideas are not consistent with each other. So, I also asked you to come up with the number of stars in the known universe and compare that to the number of dendrites and connections in the human mind.
Yeah, it was actually very similar. It was only off by, I think, a factor of 10. So I think it turned out to be 7 times 10 to the 22nd. So it was a little bit, it was 10 times less, I guess.
So 7 times 10 to the 22nd.
Yeah, if I remember correctly.
Okay, so that's a big number. Now, I also asked you, and we'll put you on the spot again, to come up with the number of grains of sand on the planet. Ballpark me.
I believe, this one I'm not sure. I think it was 2/3 the number of stars in the universe, so it would have been, I guess, 4 times 10 to the 22nd.
Okay.
Somewhere around that.
So
range.
basically, there are 25% more stars in the universe than there are grains of sand.
Yeah, if I remember correctly.
Okay, so we're going to get all that. And here's the great thing about all those numbers: you guys probably don't know how to check them. So we could be making them up, but we're not. We're not. We got real research to back all this up. So, but we're going to solidify those when you guys come to Cincinnati. I'm going to have the real numbers. My point is this: that the market is an absolute amazing machine that really, I believe. I'll just go on the line here with you. I believe in God. I believe in God, and I believe there are some things that God does not want, quote unquote, mankind, womankind to know. And this is one of them. I mean, you would have to know the mind to predict stock market prices. You would have to know the mind and heart of every single person on the planet. And then you would have to know what new news is coming in this stream of unpredictable events going into the future. And I just think it's amazing. If you look at the wealth that's been created by the market, it's really a gift that really is incomprehensible by mankind. And we destroy it with government intervention and with these different types of policies. F.A. Hayek understood that. He wrote in 1974, Nobel Prize winner, self-ordered systems are more powerful than human order systems. He didn't have the language of the day to understand it, but these are also, self-ordered systems also are known as chaotic systems, as Lorenzo talked about. The market is an information processing machine, which explains exactly how the market creates all this wealth. What do we got going out on the Twitter stream out there, Zach?
We've got a couple of somebody. P.S. Allman said that's a big ballpark as far as the numbers are concerned. Kurt CPA says neurons times population equals our future deficit at the rate we're going. And he also gives a plug to Navigating the Fog, where Jeremy Siegel states that the passive equity premium remains the same through all this history and change.
Jeremy Siegel. He's the man. So, in 1990, Sharp, Miller, and Markowitz honored with the Nobel Prize for their theories of investing. And in 1991, yes, boy from the hills of West Virginia, spurred on by the financial planning background and acumen of his father, opens a small little company called Matrix Asset Allocation with 0 clients and a dream that takes all of this information, all of this research, all of this history, and works with advisors and coaches across the country to put this into one investing process. And then realizing with over 20 years of experience with working with advisors and investors, creates an educational and coaching process to keep this discipline over a lifetime. Because these concepts any one of these concepts are almost impossible to understand if you're not spending a lifetime trying to understand them and integrate them into your actual investing process. This process is not a pie chart. And I think many times investors kind of, they get a report, they see a pie chart, and they go, oh, pie chart. So much more goes into a successful investing experience. And this data, this robust history that we have that actually goes into building portfolios, this is not static. There is always new research, there is always new data, but it has to meet the mustard. It has to be academic, it has to have theory behind it, it has to be not market timing and stock selecting. I'm sure 20 years from now there'll be fine-tuning to this process and this model, but that will have to be seen as new academic information comes to fruition. History of investing, very important. If you don't believe in something, you'll fall for anything. This is what we believe in.